If you're selling your home in New Jersey, taxes quietly eat at thousands or tens of thousands or even hundreds of thousands of dollars of your profit and your equity at the closing table. There were major tax changes in 2025 that 2026 sellers are now bearing the brunt of, and today we're just going to break it down again, talk about the taxes that sellers face in New Jersey, both state and federal. So welcome back to the Wilton Report. I'm Josh Wilton, and I co-own and run the #1 boutique and the only locally owned and operated real estate company in central New Jersey, in Princeton. And I've helped thousands of people buy and sell real estate, which gives me a front row seat to help you make smarter decisions. In this video, we're going to talk about the realty transfer fee, the mansion tax, which the state named the graduated percent fee because I think they realized that two-bedroom Cape Cod selling over $1 million wasn't a mansion. It's bad PR. The New Jersey exit tax, the federal capital gains tax, and the New Jersey capital gains tax. A lot of taxes. I guess that's the whole point of this episode. Like, my God. So the first tax we're going to talk about is the realty transfer fee, or RTF. So this one, I can honestly say, like, I can understand it, right? So it's a state tax that applies to every home sale in New Jersey. It doesn't matter, condo, townhouse, single family. It was established in 1968 and was created to offset the administrative costs that the state has in tracking real estate transactions, which makes sense, right? Like, the state's incurring the cost to keep track of home ownership, prevent title fraud, all these things. The seller pays the fees at closing. It is required before the deed can be recorded. It's calculated in increments of $500 of the sales price. So there are some exemptions for seniors. So here's how it works. The first $150,000 of the sale price, it's $2 per 500. $150,000 to $200,000, it's $3.35 per $500. And then $200,000 to $350,000, it's $3.90. Over $350,000, it's about $6.05. So on a $500,000 home, it's about $39.20. Obviously, you can double that for $1 million. So let's just round it up to $8,000. So it makes sense. States incurring costs, tracking all these things, all the real estate transactions that happen. It's a cost to directly offset the transaction costs. Makes sense. The mansion tax. This one, man, oh man, the state is just using real estate as a piggy bank here in New Jersey, as all state governments tend to do. So the mansion tax, which was renamed the graduated percent fee tax, is newer. And it was newer twice. So it used to be, right, where the buyer paid some of it. Now it's completely on the seller. It was changed last year and signed into law. So if your home's over $1 million, you're paying an extra tax, right? They call it the mansion tax, except that the reality is in New Jersey, you're not getting a mansion for $1 million. So here's how it works. 1 million to 2 million, it's 1%. And it's shifted from the buyer to the seller. 2 to 2.5, it's 2%. 2.5 to 3, it's 2.5%. 3 to 3.5, it's 3%. Over 3.5 million, it's 3.5%. So again, this and the RTF cost are paid by the seller at closing. So the seller's paying a pretty whopping tax to the state of New Jersey. Why? I don't know, because I guess the state is broke and is looking to use real estate as a piggy bank. I don't understand all of a sudden why, this tax was put into place, but it's there and the sellers are absolutely getting clobbered at the closing table. And don't kid yourself in thinking that this is not part of the seller's calculus of A, not putting their house on the market, or B, passing it through a higher cost to the buyer. Like, don't kid yourself in thinking that's not happening. Number 3, the New Jersey exit tax. The New Jersey exit tax is a required tax. It's a withholding collected at the closing when a resident is moving out of state and they're now a non-resident. So when a non-resident individual estate or trust sells in New Jersey, there is a New Jersey exit tax. So it's not necessarily a separate tax. It's not an extra penalty. It's a temporary prepayment of your state capital gains income tax. So what it means is when you sell your house in New Jersey and you've already moved to Florida, they're going to hold your income taxes out of the equity of your house, right? So who's it apply to? Anyone selling property in New Jersey that's moving out of New Jersey or already lives out of state. Full-time New Jersey residents staying in the state are obviously exempt. it comes out to about 2% of the total sales price. It's a minimum floor because, again, it's a hedge against the future payment of your taxes. So then let's switch to federal capital gains tax. There's two types. There's short-term and long-term. So short-term, it's owned 1 year or less. Your profit is taxed as ordinary income at your standard federal tax bracket, which can range anywhere from 10 to 37%. Long-term, which is owned more than 1 year, the tax on your net profit is 0 to 15 or 20%, depending on your taxable income. For most individuals, you can budget about 15 to 20% for federal capital gains income tax. So again, the primary residence exclusion for federal capital gains, you can exclude $250,000 up to $500,000 if married of the capital gains from your income if you meet the following IRS conditions. First, you own the home for at least 2 of the last 5 years. Second, you use the home as your primary residence for 2 of those 5 years. So we have a client that's actively selling their house locally because they moved out, they've been using it as an investment property. They're selling it now to keep the federal gains exclusion, the primary residence exclusion, because they'll save some significant coin on their taxes. I have another client who moved to Michigan, is living with his daughter, is not going to sell his house, is not going to put it on the market, is going to wait for the estate to take it because he will save the estate will save closer to $500,000 in federal capital gains taxes. He's lived in the house about 35 years, bought it for next to nothing. Here in town, it's worth over $2 million. So again, he's going to save a lot of money on the federal capital gains tax. I'm not going to get into that. I did that on a different episode. For the federal capital gains tax on investment and rental properties, you owe capital gains on the profits. And again, budget 0 to 37%. I would budget 35%. So if you wonder why investors don't want to sell their investment properties, they don't want to give the federal government 35% of their equity. It's just, you can ask a million investors why they hang on to their properties, maybe past the time that they should. They don't want to give up the money to the federal government. It just is what it is. They almost on principle refuse to sell. Can't say I blame them. It's a lot of money. So again, if you claimed depreciation on the property while owning it, you'll face a depreciation recapture tax, which is federally capped at a flat 25%. So what that means as an investment property owner, if you put in a new furnace, you get to depreciate that furnace over time, right? When you sell it, the feds want their money back, basically is what they're saying. New Jersey capital gains tax. New Jersey treats capital gains a little bit differently, right? It does not have a special capital gains tax bracket like the feds. Instead, your gain is taxed like regular income. So roughly 1.5% to 10%, could be a little higher, 10.75, depending on your income. There's no separate long-term gains rate. It's just one rate. New Jersey honors the same exclusion, $250, right? For single, $500 for married. So it actually has the same exclusion. If you're moving out of state after selling, the state may withhold money at closing, again, through the state withholding process. So how to reduce your New Jersey taxable gain? Keep track, and this is for any state and federal, all your renovations, all your capital improvements, the new furnace, the new hot water heater, the new roof, the new siding, the new deck, all of it. Keep receipts. Certain closing costs, realtor commissions, other allowable selling expenses become tax write-offs, right? So keep track of everything as a homeowner, have a file, put it on Google, save every receipt, and then get a CPA when you sell your house and make sure you take advantage of the tax laws as a homeowner. So again, let's do a case study. Married couple sells their home in New Jersey for $1.9 million, right? They bought it years ago for a lot less, right? So they have a chunk of equity in this property. It's a primary residence. They lived there 2 of the last 5 years. So the federal capital gains tax, right? The first $500,000 of gain can be tax-free if they're married, okay? Only the amount above 500 may be taxed federally. So again, it's 15 to 20% for high income. New Jersey state tax. So again, let's just say you bought the house for, let's use easy math, $200,000. It's now worth $1.5 million, which is very legitimate if you've lived in Princeton for a long time. So 200 plus 5, and you're married, 200 plus 500. So the first 700,000 is exempt from federal taxes, right? So from 700,000 and 1.3 million, you're going to pay federal income tax. It just is what it is. So New Jersey state tax, the first $500,000 gain may be excluded, right? And the remaining taxable gain is up to 10.75%. So again, and then you have the exit tax. So if you're leaving New Jersey, let's say you're going to a different state, right? We see a lot of our clients, baby boomers, going to New York City, going back to New York. So if they're still in New Jersey at the closing, there's no exit tax. They've already moved out of state before closing. It can be up to 2% withheld against your last year's income tax. So, if they haven't lived in the house for 2 of the last 5 years on a $1.9 million sale, you're not getting that $500,000 exemption. You're just kind of paying taxable income on the property. So again, if you bought it for $200 and you've been managing it and renting it, and now it's worth $1.5, you're paying on $1.3. That's a lot of money, right? So the same thing for the state. And then if you're moving out of state, or you've already moved out of state and you're an investor, you're paying the exit tax as well. So, when you think about the New Jersey tax scenario, it's pretty onerous. I strenuously disagree with the mansion tax. I think it's ridiculous. I had a client, local business person, lived in Princeton his whole life, ran a business, had a lot of employees. And when you're an employer, you pay tax coming and going. All he did was live here, right? Had a business, supported the town, selling his house now, right? It's a townhouse. It's not like super fancy. Sold over $1 million. He's paying the mansion tax. I don't get it. Like, that one to me is a tough one to swallow. The realty transfer fee, the graduated percent fee, which is the mansion tax, New Jersey exit tax, state capital gains, federal capital gains, right? So part of this is you have to time your move carefully. If you've been in your property a long time and you're moving out of state, start talking to your CPA, start talking to your tax advisor, start talking to your financial advisor. Come up with a plan. Maybe like if your kids are in the state, take up residence with them for a few months and then move out of state. Like, if that's your plan, watch the $1 million thresholds, right? 1.9 to 2 million, there's a big difference. 999 to 1 million, there's a big difference for sellers. So as we're negotiating contracts, these are all taken into account, right? So just kind of track your home improvements too. Any dollar you spend, document the renovations, increase your cost basis, and reduce your taxable gain. Very important to do. So selling a home in New Jersey can be profitable. It can be taxing, but knowing what taxes are coming up lets you plan ahead and keep more of that money in your pocket. So hopefully you liked this video. If you did, hit subscribe and drop any questions in the comments below. I will definitely answer them. As always, thank you for tuning in. I'm Josh Wilton. This is the Wilton Report, and I'll see you next time.